Well, hello. Welcome to my studio here in fabulous Las Vegas. This was a requested lecture on types of customer accounts. Um, if you are enjoying the lectures, they're helpful. Please like, share, or subscribe uh, to the channel. Uh, FINRA 2111 suitability rule says an associate person must have a firm understanding of both the product and the customer. So you want to make sure you really have the products down, the various investments, but you also want to make sure you do a good job. Spend the preliminary time you spend with the customer doing what's called data gathering before you open the account, because that will help you immensely in terms of trying to determine suitability. So a lot of us like to start with the customer by saying, listen, why don't I figure out right now what is your net worth before we start our relationship, and see if perhaps we can't grow that net worth for you. Now, the balance sheet on your exam is testable at two levels. A balance sheet is testable from the corporate perspective, but it's also testable from the individual's perspective. And so I might want to say to the customer, can you tell me a little bit about your current assets, things we plan on turning to cash within 12 months? Maybe that would include a money market fund, or if you don't have a money market fund and you need some liquidity, maybe I would recommend that to you. Let's talk about your long-term assets. Maybe you got a growth mutual fund there, or a partnership investment. Let's talk about what you owe. What are the things you need to be paying within the next 12 months? What are your long-term liabilities? So you maybe have X number of car payments, and you have a mortgage that's in a car that's over a year, but those current payments that you're going to be paying within the next 12 months would be part of this. Now, working capital is current assets. Current assets minus current liabilities. Now, you're more likely to see this in the perspective of a corporate balance sheet, but and you're more likely to see this on a 65, 66 than you are to see it on a 7 or SIE. But it's within the test specifications on all those. And so current assets minus current liabilities equals my working capital. Now, if you learn these in your own personal situation, you'll sound a lot more sophisticated. People say, hey, would you like to, go somewhere? I go, on an international trip, for example. I said, well, I'd like to, but I'm having a little bit of a liquidity crisis. I mean, these two things I'm talking about are about liquidity. By the way, my friends didn't get this one year. This is several years back, but I didn't want to liquidate any investments. It would have been very easy to fix this problem, my liquidity problem, because I could have turned a long-term asset into a current asset by selling it, but I didn't want to do that. So I was sucking it up, and I was kind of whining a little bit, and people started picking up my bar tab, and I was wondering what was going on. They said, Dean, we hear you're having some financial troubles. I go, well, I hope I didn't misrepresent it. I'm not poor. I'm just having a little bit of a liquidity issue here. I'll get past it. It's April, and I got to pay my taxes, and I'm sucking it up. I could take care of that. By the way, we could do that. We could turn a long-term asset into that. That equals working capital. We also want to know how much liquidity makes the person comfortable. I had a lot of clients who are self-employed, and maybe they need more liquidity than others because they're not really like getting a paycheck. And then we might want to do this ratio. We do this ratio. I like to keep on my own personal finances. I like to keep a current ratio of about 2 to 1. $2 in current assets for every dollar I have in liabilities. Sometimes I'm more or less. And traditionally, just like the real world, right? Dean has become, a little more conservative as I've become older. I, like to have more liquidity. I'm not as aggressive on investments as I used to be, but, oh well. So I'd be aware of both of those in terms of the customer. And then what we would like to do is say, okay, here's our starting point. Because this personal balance sheet we're going to do is a picture in time. As of, March 11th, 2021. And maybe we're going to do it every 6 months or every quarter or once a year. We're going to review our balance sheet and see what progress we've made in terms of your net worth. What I'm trying to do is get it to a point where right now you're working for money, and we can put enough money work for you that at some point I can call you and say, hey, listen, you don't need to work for your money any longer. We got enough money working for you that if you want to, you can tomorrow, instead of calling in sick, you can call in rich. Say, I got an eye problem. They say, what's wrong? You say, I can't see coming to work. Maybe you want to go to work, maybe you don't, but oh well. So we're doing our data gathering here before we open the account, trying to determine suitability for the customer. I say, for me to do a really good job for you over time, I need to know a lot about you. The more I'm going to know about you, the better I can be in determining suitability and making recommendations. And you say, well, Dean, that's none of your damn business. And I say, well, no, it actually is my business, because my regulators say that I have an obligation test question to know my customer. Right. So, the more I know about you. So here we go with the balance sheet we're just discussing. It's a picture in time. Where are you at today as of, March, what's today? March 11th, 2021. By the way, if you are the one who had requested this lecture, I told you the first quarter is my quarter I've devoted to establishing the YouTube channel and putting my content on there for you to help you out. And I am taking requests. We're going to do a suitability exam. So we're going to have a couple more. But at the end of Q1, the publishing schedule on the channel will drop dramatically, because that'll be the end of my first quarter kind of goal. And, I'll get back to my regularly scheduled life. We'll still be publishing, but on a less frequent basis. And that means you need to subscribe to the channel and get your requests in now before we're not going to go dark, but we're going to go, a little less activity. Anyways, that being said, your income statement. So I want to see how much money you have coming in, your income statement. Now we're talking about an individual, not a corporation here, but remember, if you're showing me your paycheck stub, not all of that is flowing through to you, right? Cash flow is what we actually have to deploy into perhaps dollar cost averaging. I say, listen, based on what we've looked at here in your income statement, your cash flow, it looks like I can recommend an investment program that we can live with. Can you give me $100 a month or $200 a month to put into the mutual fund? And then again, we do it again. We do another balance sheet. So, for example, if this is 3, 11, 21, and then we do this again on 4, 11, 22. We're going to see where we're at now. And then most importantly is, where we're heading to, where we're trying to get, whether that's, net worth wise or investment goal wise, whatever the case may be. Let's clean up the slide there. I might say, hey, I'd like to read you a list of investment objectives. I'd like you to rate them on a scale of 1 to 10. 10 being very important, 1 not important at all. Are you with me? Growth, 0. I said, well, listen, it was 1 to 10. You say 0. Income, 10. Safety of principal, 10. Tax advantage, 10. Speculation, 0. Maybe I recommend a AAA muni bond fund, for example. Now, in terms of determining suitability, it's much more recognizing what would be clearly unsuitable given somebody's investment objectives, right? In that example, they told me growth and speculation was a 0. So, I shouldn't be recommending options, perhaps, no calls or puts, or, a growth fund or growth stock, so you want to recognize what would be inappropriate. I had a client one time. He said, Dean, I'm already rich. Just don't make me poor and we'll get along fine. That's a different investment objective, right? What's your time horizon? That's a good one. The difference in tragedy and comedy is timing. I joke, if there was just act 6, scene 1, everybody on the stage would still be alive. I had one customer when I was opening the account, he said, Dean, I'm so old, I don't buy green bananas anymore. Right. So, obviously we're not going to be putting him into a real estate limited partnership if, he's got to buy green bananas. He told me he wants to buy 3 to 5 year investment grade muni bonds. And every time I'd call him and I'd be out of that range, I'd say, well, it's 6, but I like it. And he said 3 to 5, 3 to 5. Well, anything that doesn't go on the balance sheet or the income statement is non-financial. And, we got to worry about your psyche. These are psyche kind of questions more than they are about things that would go on a balance sheet or things that would go on an income or cash flow statement, right? Your age isn't part of that balance sheet, income, or cash flow statement. That's marital status isn't on there. right? Your employment isn't on there. Your risk tolerance. Do you like volatility? Do you embrace volatility? Some people like to see their stuff bouncing around. Some people do not. So what is your risk tolerance? Tax status, really important, right? Now, that'll help us decide whether perhaps we should be buying you, not on the balance sheet again, not on the income statement, not on the statement of cash flow for our customer, but certainly something that will help us determine whether we want to put you in a tax-free community bond fund or a taxable money market fund. What are your goals? What are you saving for? Are you saving for a college education? By the way, the 529s ESAs is on the Muni lecture, not here, so that won't be covering that. But are you saving to buy a new house? Are you saving for, to retire? Are you saving you can donate to a philanthropy? Whatever the case may be. This is just a review. I've talked about this before, but it's just testable. And you don't want to be giving up questions that are just aim and shoot, point, click, stuff you just simply know or something you don't know, right? So if I'm opening an account, I say, listen, I have private placements. Those are investments by invitation only. And I'd like to see if I'm going to be able to extend you an invitation to these private placements. Do you have test question and net worth of $1 million exclusive of your primary residence? By the way, if I did my balance sheet and my income statement and my cash flow, I should already know the answer to that, right? Because I would have taken your assets minus your liabilities and I'd come up with a net worth and it was over $1 million. By the way, I'd toss out the equity in the house, which shows up on the asset side, right? The mortgage shows up on the right-hand side. I would know that. And I would know from my income statement whether you had $200,000 the last 2 years or if you're married and filing jointly. Very testable. Every question is only worth 1 point, but to be honest with you, some of these questions, if you miss them, I would just take out like 20 points and say, how could you miss that? I mean, you were told it was there. I mean, you need to be able to perform. I'm not going to be discussing margin accounts because there's a whole margin lecture that I'm pretty proud of and I think is spot on. So it's one of the few lectures, usually I tell you these lectures are supplemental to whatever study materials you're using, whether it's Kaplan or STC or Past Perfect, whatever the case may be. But, I do have some lectures that I think are sufficient. I think if you watch that margin lecture, you're done with margin. Anyways, there's two basic types of accounts at the broker dealer. There are cash accounts where we intend to pay in full, and that is required for retirement accounts. That's required for UTMAs. That is very much a test question. Must be cash accounts. We can't leverage up the kid. I can't wait till he reaches the age of majority if it's an UGMA, from Gift to Minors Act, or the age stipulated up to age 25 if it's an UTMA account, from Transfer to Minors Act account, and say, hey, I'm glad you reached the age here. Something about a maintenance call. No. Now, on a margin account, as you recall, or should recall, I don't know what sequence you're watching lectures or doing your study, but a margin account is where the customer intends to pay part of the purchase price and wants the broker dealer to lend the balance. Now, if I'm going to be borrowing money, if the trust is going to borrow money to purchase securities or the corporation or the partnership, I put a question mark there because what we're going to need is a copy of either the trust, a copy of the trust itself to see whether margin is specifically permitted in that trust. If it's a corporation, we need a copy of the corporate charter to see if margin is specifically permitted within that corporate charter. If it's a partnership, we need a copy of the partnership agreement to see whether the partnership agreement allows the partnership to borrow money to purchase securities. So it's got to be specifically permitted within the documentation. Full versus limited power of attorney. Now, I've discussed this in types of orders, and I've discussed this elsewhere, secondary markets, but again, this is kind of a reminder. A full power of attorney is where you're giving a third party not only the ability to trade your account, but also to withdraw monies and securities. Limited power of attorney only gives that third party the opportunity to make investment decisions for you, right? This is called a discretionary account where a third party has the authority to be making decisions. I saw a PBS special. It had nothing to do with our business. They were following a rookie around in the NFL. And, this rookie goes on this bistro and he says to this retired NFL player, do you have any advice for me? And he said, never grant your broker full power of attorney. I said, ooh, also known as full trading authorization. And I said, say it ain't so. Well, apparently he got his 7, he got his 66. He went back to his teammates and said, if anybody understands the financial problems indigenous to being a high income producing professional athlete. It's moi. Why don't you give me full power of attorney or full trading authorization? Not only can I make investment decisions for you, I'll be able to pay your bills, take care of your, entourage, and you can worry about just being the best football player you can be. I'll treat your money as if it were my own. Now, on the test, you got to believe in human depravity and original sin. And if you believe in human depravity and original sin, you won't be surprised what happened. When they arrested this broker and asked him what happened to the money, he said it evaporated. I guess it was a hot, sunny day. It all went poof. Now, with limited power of attorney, by the way, remember, you can only cut the checks, by the way. The checks are cut to the title of the account. So anyways, limited power of attorney only can make decisions about action, whether to buy or sell, the asset, which security to buy or sell, and the amount, the quantity. If I'm making a decision about one, two, or all three of those A's, I need trading authorization. Now, I've covered that elsewhere in the lectures. Just a review here. I do not need trading authorization to make a decision about time and price. That's called good execution. And that does not require me to have a limited trading authorization or limited power of attorney on your account. And if you review types of orders, which I highly recommend, or secondary markets, which I highly recommend, the example I give you is a market not held order. A market not held order is where I tell my floor broker to take it into the crowd, the auction, and do whatever time and price he thinks looks good. Buy 10,000 shares, GE, whatever time and price you think looks good. Now, if it's a durable power of attorney, my power of attorney exists if you're legally incapacitated. So if it's not, then it ceases there. But so we have two. We have durable power of attorneys and power of attorneys are not durable. Durable means my power of attorney, as your third party who can trade your account, survives your legal incapacitation. Now, there's no version of a power of attorney that exists once you die. So once a customer dies, that ends the power of attorney, the trading authorization. Prime brokerage accounts, I've talked about this elsewhere. A prime brokerage account is typically where the institutional customer of the broker dealer, like Goldman Sachs, a hedge fund, tells the other firms it trades with, Morgan Stanley, UBS, BTIG, listen, I'm going to do the trade with you so your firm can earn the commission or markup or markdown because you brought that to me. It's your idea, and so you should be paid on that. But I don't want to have a bunch of different, accounts. So I settle up with Goldman Sachs, my prime broker. My prime broker provides me as a hedge fund with custody and financing. So, that gives me one set of statements instead of, getting, 6 or 7 different statements. Another type of institutional account, very similar, by the way, is delivery versus payment or receipt versus payment. So this is where I tell my broker, I say, listen, I don't need you to hold my monies and securities. I have a commercial bank, State Street Bank and Trust, and I have a DVP account at State Street Bank and Trust. Now, that means the broker doesn't know what I'm holding, which is, the point of having this account. He doesn't know what's in my State Street DVP account. And I say, listen, if you don't do a good job on the buy side, you won't get the sell side. I'll give the sell side to some deserving broker. So if I buy 10 million shares of GE, deliver it to State Street, and they'll give you payment. The test question here is I have up to 35 calendar days to deliver that security. Now, it's not going to take me 35 days because I want my money and I want it like now. So my example, Goldman Sachs, is going to take 35 days to deliver that security to State Street to get paid. In the real world, outside of your Fantasyland test, it's going to be a lot much quicker than that. But I'd want the customer to assure me that, the bank, the paying agent, the bank knows I'm going to be delivering the security. I haven't transacted that with DVP customers in years and years and years. But when I did have DVP accounts, I can't tell you, it never settled quickly the first time. But once I settled the first time, then it worked, right? And I've literally had people on the phone saying, hey, down the hall to the left. So I imagine today now this is much more electronic. We're settling much more quickly than when Dean came into the business in the early 80s. Here's our day trader. Looks like he's pretty happy. I would imagine looking at his chart that he's long, because with a smile like that and a chart like that, that certainly wouldn't be the case if he's short. But if he does 4 or more day trades in a 5 business day period, then his minimum equity is going to be 25 grand. Do you remember the minimum in a margin account is 2 grand for just, initial transactions, but not if you're going to be a day trader. And then we have to give you a special risk disclosure telling you that Day trading is hazardous to your financial health. So he's smiling right now, but he may not be smiling later. Cross guarantee, I don't think you're going to see this on your exam at all, but it's where we don't allow customer A to guarantee customer B so this guy can still trade, right? So him and I are buddies. We're both trading at the same firm. And he says, Dean, can you guarantee my account so they'll continue to let me trade? That used to be allowed, but now that is no longer allowed. Don't think you're going to see that. And all accounts have to be approved by principal, so you shouldn't be struggling with that. That's true of all accounts, whether it's a day trading account or not. Individual account. So only an individual owner can make trading decisions, withdraw cash or securities, and have their name on the check or certificate. Again, it doesn't matter what type of account we're talking about. The checks are going to be cut to the title of the account. The suitability is just going to be based on that sole owner, right? I don't have to check with anybody else because it's their account. Very testable on all your exams. You have to be able to contrast joint tenants with rights or survivorship with joint tenants in common. You must be able to contrast these two. That's why I put versus. So how are they different? How are they different? I had somebody tell me that somebody called them and said, there's a missed typo on my account. My last name is not JTWROS. They said, that's not a typo. That's a title of the account. So there's no fractional ownership in the account. Both parties own 100% of the account. If one of the parties to the account dies, 100% belongs to the survivor. And the surviving party, very important, can still transact business. And that's going to be much different than tenants in common. I can't tell you how many times I've seen horror stories where, brokers have mistitled the account. You got to sit down with the customer and talk about the various types of this. The checks are cut to the title of the account. So if it says Mr. and Mrs. Jones, that's how checks get cut. Either party can act. Now, it doesn't have to be husbands and wives. I mean, I have joint tenants with rights to survivorship on mom's account. She doesn't have it on my account, but I have it on her account. Anyways, I loaned her some money and I paid myself back. And she, how'd you do that? I said, well, either party in the account can act. Joint tenants in common. There is a fractional interest, 50-50, 70-30. We could have three of us with 33.33. Each tenant has the authority to act. And then the test question, you've got to know how they are different when somebody dies. When the co-tenant here dies, it goes to the estate of the deceased. I saw this more often when I was a practitioner with, husbands and wives that are on their, second or third marriage, where they want this to make sure it goes into their estate or their beneficiary. By the way, it doesn't have to be husbands and wives, whatever it is, right? But that's where I see it most often. And that's a test question. By the way, the account gets frozen once this one of the parties dies. And so here, the other party is going to be stuck. They won't be able to transact business. Well, I always like to pull, the practice questions from the SIE, and they're appropriate for all the exams, or I wouldn't put them in there. And I like to sprinkle these through our lectures to give you an opportunity to see how questions are phrased. Listen, I was talking to a candidate the other day. This is a big time sin. He was taking his SIE and he said, should I do that practice exam the night before? I go, you should have done it long ago. I suggest you maybe do it more than once, but well. Which of the following is true regarding a customer account held as tenants in common? The owners must equally share the assets. That is false. I like on my Prometric scratch paper or my scratch paper, just put a T or an F next to each of them as I go through. The ownership of the decedent's assets is governed by their will or state law. That is true. The tenants in common is permitted for only two individuals. No. Tenants in common is permitted for, nope, it doesn't have to be husbands and wives. And so the answer is B. UTMAs are very testable. You can expect more than one or two, maybe even three questions on UTMAs. By the way, types of accounts are very testable. I mean, the life of being a baby broker is opening new accounts, right? So, if you can't open the new accounts, you're not going to make it. I had a guy who was telling me he's working at a firm and, he's not very happy that he's talking on the phone all day long. I said, but at least you're talking on the phone to real customers about real investments. If you were in a sales mode, you'd be trying to find the customers. You wouldn't have anything to talk to them until you got some customers and built your book of business. But anyways, Uniform Transfer to Minors Act, Uniform Gift to Minors Act. This is account for a minor with an adult custodian. Very testable, one-on-one. You can only have one minor and one custodian in this account. You can have multiple donors, but only one minor. So if I open this for my nephew, I'd be Dean Tenney as custodian for Brian Tenney, UTMA, Nevada. Now I would use UTMA because with this one, I can stipulate up to the age of 25. This is the age of majority, depending on the state. And that would be 18 or 21. And usually the minor is going to be probably have better judgment at 25 than they have at 18 or 21. The custodian has full control of the account. The gifts are irrevocable. When I was a baby broker, I had a doctor customer, and I had an UTMA for his daughter Betty, and that UTMA had close to $300,000 in it in monies and securities. Anyways, I never realized that Betty actually existed in the real world because I've never ever talked to her. And I get a call one day and they tell me Betty's on the phone. I go, really? I pick up the phone. She says, I hear I have an account. I said, you certainly do, and she said, well, I get some quotes. I go, yeah. And we went through the quotes. Now, if you know that I tell you like 80 and you know that that's around that, you would know that's $8,000 at least. And when we got all through this, going through the quotes and talking about her position, she said, do I have enough to buy a Corvette ZR1? I said, well, Betty, you certainly have the resources to buy a Corvette ZR1, but have you talked to your father? And then she said, well, the way I understand this UTMA account, once I reach the age of majority and provide you with a certificate of incumbency, you're going to have to register those assets to moi. I thought, wow, for somebody who didn't get around much, she got pretty sophisticated pretty quickly. I said, gee, where'd you hear that from? She goes, from mom. Anyways, next call was the doctor. He said, Dean, if you liquidate any of those securities, you will never see another trade from me or any other doctor in this hospital. I said, well, doctor, if you want to be dictating terms to Betty from the grave, you need a trust, not an UTMA, because test question, the gifts are irrevocable. I told you this is a test question, one minor, one custodian per account. The donor securities can act as the custodian or can appoint someone else. So as I mentioned, you can have somebody else that does this. The parents have no legal control unless they're the custodian. So if I'm grandpa and I'm the one who's the custodian, I got control on this thing. The minor, we live in a very litigious society. So, the minor can always sue. You can always sue anybody about anything. One other test question. We don't open accounts for minors directly. So the only way we're going to open an account for a minor is through one of these custodial accounts, either an UTMA or an UGMA. By the way, I don't see it here. Let's add, there we go. I just want to make sure you have that as a test question. That too is a test question. Remember we had another test question, no margin. So it's got to be a cash account. UTMA accounts are open to the tax ID of the minor. That's very much a test question. You want to get these aim and shoot, point and click questions correct. Transfer on death account. When inheriting securities, the cost base is stepped up. What the IRS assumes you did is transfer ownership into your securities to your estate. Now, it's not a problem for you, but, if your estate can't pay the, tax, you might have to liquidate the securities, and that would be a problem. But it's more flexible than having a will. It avoids probate court. Death of a customer, we all cancel the open orders and freeze the account. We're waiting for, the legal documentation. We need the legal department to, help us out with an affidavit of domicile and letters testamentary. And, so what I'm not supposed to do is liquidate the account, right? They have questions that you can get right with what I call reduction to the ridiculous. What does the world look like if this is really a right answer? One thing they might offer you as an answer is when somebody dies, we liquidate their account. Absolutely not. That will lead to a world in which people are killing their customers so they can liquidate the account, saying, hey, what does he care if I charge him full? No discount on these trades. This is a very good example of how we test on this. So what is the cost base of inherited securities? The market value when the owner dies. That sounds pretty good. Now, what I like to do is either put yes, no, or T or F or a question mark. But, I'm a little gun shy about jumping right on the A answer because I want to check my answer set and see if there isn't something I don't like better. I like A a lot because that's what that means, right? The market value, as we said, that's what that means in English, this idea of the step up. When Jack Kent Cooke died, Jack Kent Cooke was the owner of the Washington football team. And they assumed that he just transferred ownership to his heirs at $800 million. And his estate didn't have the money to, pay the estate tax, so they had to sell the team. This happens a lot. Ford Motor Company went public because they couldn't pay the estate tax when Henry Ford died. Estee Lauder, went public so that when she died, they just sell X number of shares to pay the bill. But anyways, there's a step on the basis. I like that one. Let's look at our next one. No, listen, if we haven't talked about it and you've never seen it anywhere, it's not the right answer. I had a guy who called me one time and good news, he passed. He goes, Dean, what's a Murphy account? I go, I don't know. I've never heard of a Murphy account. I mean, we have cash accounts, margin accounts, accounts. I've never heard of a type of account called a Murphy account. I said, well, why would you even answer that? He goes, well, it wasn't in my study materials. You never talked about it. So I figured it was the right answer. Listen, if we've never talked about it, you've never seen it anywhere. I don't care how good it sounds. It's not the right answer. They're very good at coming up with distractors. That's the technical name for wrong answer that sound good, but are not correct. The same cost base? No. Nope. Boom. That's good flashcard fodder too. If you're going to make your own flashcards, that's a good one. Where flashcard would mean you just put the question, the answer, question on one side, answer on the other. We have various types of business accounts. And if we're going to open an account for a sole proprietor, that's the simplest structure. The I and the business are one and the same as a customer. I don't know of anybody conducting business as a sole proprietorship. I mean, there are advantages to a sole proprietorship, but there's also disadvantages based on this. Now, you're more likely to get questions about partnerships as investment vehicles rather than partnerships as in a type of account we open. But yeah, I opened an account for the Las Vegas Raiders. That's a partnership. And remember, I need a partnership agreement. I'm going to need a partnership resolution that tells me who's allowed to authorize to call me and buy and sell securities. Right? Is it Mark Davis? Mark Davis is the general partner of the Las Vegas Raiders, or is it somebody else that he's going to allow to do this? And as we said earlier, there's a flow through of the profits and losses. There is no, retained earnings in a partnership. So the money's going to flow through. Now, I think that's more testable again as an investment vehicle where you're going to be a limited partner than it is in terms of types of accounts. But, we can open an account with a partnership. And then, it's not just the GPs, it's the partnership's objectives. Limited partner, the general partner has management responsibility. Limited partners provide the capital. So the point is, the limited partner is not going to be trading or have that authorization. They'd be foolish to take it because that could violate their limited partnership status. We have LLCs, limited liabilities for the members. We would consider collective suitability. There's no limit on the number of members that we can have in an LLC. We have S Corps as potential customers. They too have a flow through of income and losses. They have a maximum of 100 shareholders. And then we could have, don't we wish, a C Corp as a customer. Wouldn't that be cool if you had the brokerage account of Apple and they're buying, $10 billion of stock back into the treasury and you're the broker on the account? Woo! Right? Apple is different from its Apple shareholders in terms of conducting business. And again, here, we'd want a copy of the corporate resolution saying which corporate officer of Apple is allowed to call us and make investment decisions on behalf of Apple. So we'd want to have a corporate, it's called a corporate resolution. We're going to need a name. We're going to need a physical address. A physical address. People do not live in P.O. boxes. And so we want to know where to send Guido for the maintenance call if need be. I'm joking. But once we have that physical addresses, we will send things to a P.O. box. But on the original hard card, the original documentation, we need a physical address. We need a phone number in case you get a margin or maintenance call. We need a tax ID number. Occupation would be important. In every new account form, we ask you, what do you do for a living? And we have a separate question. Do you or your immediate family members work for another broker dealer? Because that's very important. If you say yes, I say, well, I'm making a written notice to your employing broker dealer. I'm going to follow any special instructions they have in terms of duplicate confirms and statements. We need to know whether you're a citizen. We need your date of birth. We need your investment objectives, marital status. I talked about this, right? Whether the spouse is employed by another member. Now, remember that amounts to permission because the firm can restrict the activity if they choose to. You need a picture ID. Are we clear? A birth certificate. The one they like on the test is a birth certificate. And a birth certificate would not be appropriate. And are we clear why that would not be appropriate? Because that doesn't have a picture on it, right? My mom is over 65 and I'm her trusted contact person. So, if, the bank or broker dealer thinks some shenanigans are going on, they can call me as their son and say, hey, listen, your mom is trying to wire this money to this prince. I said, really? Well, thanks for the call. Did you freeze that? Yeah, we wanted to talk to you about it. I said, gee, I thought mom had watched enough Dr. Phil's to, not fall for that one. Oh, well. Don't get hung up on this. This is true of all accounts that we need to have a principal accepted. A lot of times I get people in 24 classes or 24 tutoring because they're going to be people accepting accounts on behalf of the broker dealer, and that requires a principal, Series 24. We're going to verify your identity. I say, listen, the information I'm collecting on your new account form is really, really important. And so within 30 days, I'm going to send you a copy, and it's very important you look it over and make sure I got everything right. Now, we realize that your financial situation can change dramatically every 36 months, over 3 years. So we'll also kick out a review to you every 36 months. Could you please review that? And if anything's changed, your investment objective or things like that, please let us know. Again, changes in account name or designation, principal approval is required. I can't tell you how many times people will, start sending their statements of their customer who's losing money to them and sending them fictitious statements. And this is designed to prevent that. Where the principal says, what? Maybe I pick up the phone and call up and say, hey, this is Dean. I'm a principal. I see you're changing your account name or designation. And we should document everything in writing. Internal transfers between joint accounts. All account owners have to approve those internal transfers. I didn't, make a special slide for customer statements, and I meant to, but I thought the question itself, I think, is sufficient for what you need to know on the test, and so I just put it here as a practice problem that once again I pulled from the SIE practice exam. A customer has a cash balance with long positions. This is very testable in several securities. She has made no securities transactions during the past 18 months. The point is, if she does make a securities transaction, if there's activity, that would kick out a statement to her. How often must the firm send her a statement? That is very much a test question, and it's quarterly. That is very testable. Now, there is a circumstance very testable, in which there would be a monthly statement. And that would be if there are penny stocks in her account. Test question, if there are penny stocks in her account, that's going to kick out a monthly statement. And it is very testable to know what is a penny stock. A penny stock, test question, is a non-NASDAQ OTC stock under $5. What that means in English is a bulletin board pink sheet stock that's under $5. So, if the stock is under $5 and it's trading on New York or NASDAQ, it is not a penny stock. So that too would kick out a monthly statement. So activity, excuse me, not activity, just that's been changed. It's not activity. It's just this penny stock. Anyways, you want me to hold your statements? I can hold your statements, but it can't just be for convenience. It's got to be security, right? So, maybe I'm traveling. I say, could you hold my statements? You said, Dean, you're able to get them electronically. I said, I know, but I'm in Mindanao in the Philippines. And if I go to an internet cafe and punch up my brokerage account, I'm going to move myself up on the kidnap list. And you say, oh, Dean, if it's security reasons, then yeah, absolutely. We can continue to hold them for you. Very important. This is very, very important. And so whenever you hear the word qualified, that means you're using pre-tax money and you have a zero cost base. So everything coming out is going to be taxable. You've met the qualifications of the IRS and the Department of Labor. And one of the qualifications for a qualified plan under the IRS and the Department of Labor is that you can't discriminate. So, if it's a 401k, for example, everybody's 401k, it's going to look exactly alike. Your contributions are tax deductible. And so it makes sense for you to take advantage of this. The tax on the accumulation is deferred. You're going to pay it when you get there. Now, non-qualified means you're funding with after-tax dollars. It's not qualified with the IRS or Department of Labor. The contributions are not deductible. You can discriminate, like deferred comp, for example. And then the test question is, how are they different in terms of how they get taxed? Remember, we said it's always about how not are things alike, but how are things different? How are things different? We're going to go over a couple examples of this. So non-qualified plans, you're using after-tax funding. So a lot of times we'll refer to a variable annuity as an after-tax, or excuse me, a non-qualified retirement plan, meaning that you're using after-tax money you've already paid taxes on. So you funded all your other retirement plans you have available, and you still want to set aside money. I say, why don't we get you a variable annuity? Maybe you're a young professional athlete, you're making, I don't know, 20 million a year. I say, why don't you give me 5 million or 20 million after tax? We'll put it in a variable annuity. A variable annuity is a mutual fund with an insurance wrapper. They're going to, instead of putting your $5 million into the insurance company's general account, we're going to put it into the insurance company's separate account. The separate account is a mutual fund. It's going to grow tax deferred. You said, well, can I get my money? And you say, no. I said, you can't get your money out of there. You, why? I said, well, because otherwise it wouldn't be tax deferred, because you would have constructive receipt. So, we put $5 million in the separate account, which is a mutual fund. We hope it grows, but now you're 59 and a half. And you say, Dean, what's in my, my separate account? I say 10 million. So you put in 5 million that you pay taxes on. Now there's $10 million in there, and you want to take money out. You say, Dean, send me the 5 million I originally put in there. I say, no. When you get a tax question on your exam, you always pick the one that generates the most money for the IRS. And the IRS says, Department of Treasury says, last money is in, our first money is out. So if I send you that 5 million as a random withdrawal from your variable annuity, it's going to be 5 million you've never paid taxes on. And it's going to be taxed at ordinary income tax rates. So you can do a random withdrawal, you can do a lump sum, take the entire 10. Right? You take the entire 10, you owe taxes on 5. Now, another great thing about a variable annuity is you can annuitize and turn it into an income stream that you can't outlive. That's not something you can do with a mutual fund. And so my athlete, who's now 59 and a half, says, Dean, what will give me the largest monthly payment? I say, if you choose life only, if you tell the insurance company that you only want to be paid for your life and your life only, that will generate the largest monthly check for you. It's called the law of averages. I mean, mutual funds are great on this, doing actuarial tables. Now, the assumption here is the insurance law of large numbers is the insurance companies going to win on some people who check out earlier and lose money on some people who, stick around a little longer than what you're planning on. So you have some various choices in terms of annuitizing. Business non-qualified plans, deferred comp, where, our senior executives are taking after-tax money and investing it. And you say, well, what about me? I said, that's not available to you. That's for our senior executives. No deferred comp for you. Payroll deduction plans, Section 457s are for public employees. Policemen, firefighters, a lot of these people have 457s available. I can't imagine I get any questions on those. I haven't had anybody tell me they've ever seen anything out of 457 or deferred comp. But if you do, let me know. All about IRAs, individual retirement accounts. You have to have earned income to fund it. They don't test you on the maximum because they don't want to have to go into the data bank, the question bank, and change it. So they really kind of fly high. So I'd be careful. Don't get too much in the weeds on some of this stuff. But, the stuff that's there is there. So, when I tell you it's something to worry about, then, I worry about it. You can have a spousal or non-working spouse. The contribution may or may not be deductible because there's a phase-in of deductibility based on, do you have access to a qualified plan through your employer or your spouse? And so it may or may not be deductible. I told you they don't want to get into the phase of deductibility because it would be a mess in terms of trying to keep the Q bank current. The earnings grow tax deferred. That's true of all retirement plans, qualified and non-qualified. And if you get the money before you're 59 and a half, there's a 10% penalty in ordinary income. I would definitely know that. There's required minimum distributions for most of these. There's some that don't have required minimum distributions, but some do. And I just recently started hearing people on debrief telling me they've seen 72, which was a recent legislative change. You should always answer the most recent information, but if I've only heard, a couple reports here and there, so I'm not so sure yet it's fully testable, but it's not going to be fully testable until they test it for validity. But I want to be very clear with you. I'm making this video lecture. I'm making this on March 11th of 2021. And you should answer with the most current information. Now, who knows? This may live until, the internet has a life of forever, right? So who knows? If you're watching this in 2031, I can't imagine you would be, but might want to check. But it's 72, not 70 and a half. There's my mug. There's my mug. And so, good news for Dean. I think I'm over 15 and a half. I probably should do the math here at some point. Anyways, if I take a transfer from custodian A to custodian B, that's not what we're talking about. We're talking about where I call my investment professional. I tell you to liquidate my securities, redeem my mutual funds, sell my stocks, and I want a cashier's check for the amount that's in my retirement account. If I take possession of those assets, by the way, I just turned it into cash, right? The test question is I have 60 days to get that back into the appropriate place. That is very much a test question. If I don't get that back in the appropriate place, it's going to be considered a distribution. I'm going to have the 10% penalty and ordinary income tax rates. Very much a test question. Qualified plan types of corporate retirement plans. Qualified plans, remember what that means? Zero cost base. Defined benefit. That's how most employers go now today. Most employers don't want to have, the risk. So very few employers anymore hand out good old fashioned defined benefit plans. I joke, this is like what your granddad got. This is where we tell the employee that after, 20 years, we're going to give them a percentage of their base pay and health care for the rest of their life. And that means the employer is going to assume the investment risk. Most employers today have gone to a defined contribution plan where we define to you as a, employee what we're going to contribute on your behalf. You invest it, whatever it grows to or falls to, that's what you get. So, in this here, it's easy to have what's called an unfunded pension liability. That's where you don't have the money you need to pay the benefits you've promised. And it's almost impossible to have an unfunded pension liability in a defined contribution plan, right? No profits, no contribution. Now, I was part of the senior management team of a company called Dearborn. Dearborn was the predecessor company to a company called Kaplan. Kaplan made an acquisition of Dearborn. And Dearborn, we had a awesome defined contribution plan. We would put into the employee pension plan 25% of the profits. We were selling books and stuff for $400 and it cost us like $30 to print them. Very profitable business. And then we would match our employees dollar for dollar on the first 6%. So you get an immediate double pre-tax. Wow. A 401k is an example of a defined contribution plan. And remember, in these 401ks and profit sharing, again, your cost base is zero. Now, sometimes they'll allow you to have like a match there, but everything coming out is going to be taxable. Retirement account restrictions, no margin. That means no short sales, because all short sales test question must be conducted in a margin account. So whether you want to borrow money from a broker dealer or borrow securities from a broker dealer, you need a margin account. We allow you to write calls against stock you own, covered calls. We don't want you to have tangibles or life insurance. And it means either you're confused or somebody's, not explaining this to you correctly. I mean, why would you put a mini bond in a retirement plan? In a retirement plan, it's a pure investment arena because you don't have the tax consequences until later. I joke about my cousin, he was making a very aggressive investment. And I said, why are you going to do that in your retirement plan? That's just a sin. Do it in your personal account. So at least if you do lose the money, you can write it off. I mean, the two major impediments to investment success are taxation and inflation. And you've already beat taxation within the retirement plan. If you can just beat inflation, you're getting ahead. And so why would you want to put a tax-free income-oriented investment into a tax, a deferred kind of environment wrapper? It just makes no sense. Senator Roth is no longer around to protect his Roth IRA. If you're a senator and you come up with the idea, we name it after you. And so Senator Roth is the guy who came up with this. If it's a House bill, it's just House of Representatives Bill number 10. And here you're using after-tax money to fund the Roth IRA, money you've already paid taxes on. So you're using after-tax dollars. There's a phase out. I would know that as a test question. Now, we're not going to get into the particulars on that on your exam because, again, we don't want to you have to go into the Q bank. And in general, you just need to know that there is a phase out based on earnings. Now, this thing is so sweet. Test question. It has legislative risk. Anytime you make a tax advantaged investment, what Congress giveth, Congress can taketh away. So, life insurance has tax benefits. Muni bonds have tax benefits. A Roth is sweet. And so anytime you're making an investment that has tax advantages, I say, well, listen, that's how it works today. But, I didn't do that to you. Congress did that to you. For example, legislative risk. Dividends of corporations paid to other corporations used to be 70% tax excludable. Now it's 50%. So again, legislative risk. It just got cut from 70 to 50. Tax-free withdrawals. Wow, that is awesome. That is so sweet. That's after the funds have been in there at least 5 years. And then test question, there is no required minimum distributions. That's kind of cool. That's sweet. You don't get the nasty letter at 72 saying you got to withdraw X number of dollars. The IRS wants to make sure you don't check out without paying taxes. So when you reach 72, they send you a nasty letter saying, actuarial tables say you have X number of years to live, and now you're required to take out this minimum distribution. If not, remember, you're going to have a huge penalty. And so the Roth does not have that. The largest Roth IRA I'm aware of is Mitt Romney. When he left Bain Capital, he rolled his 100 million plus, I don't know what his 100 million is worth now, this is years ago, into a Roth IRA. And when he was running for president, he said his wife said they could take a distribution for, I think it was 40 million, he said, as their budget for his own money in his presidential campaign. Roth 401ks and Roth individual retirement accounts. Remember, so now they're asking about Senator Roth and his idea about how this works. Which of the following features, contributions are made pre-tax? No, remember, you're making those after tax. Neither account has maximum contribution limits. No. Neither account, they do have max. That's false. Neither account, they do have that. So, boy, you got to be careful of these double negatives. Neither is subject to early distributions. Neither is subject to early distribution penalties. Qualified distributions, boom. That's what gives that thing its juice, right? Wow. No required minimum distribution. Be careful on this one. This is very much a test scenario. This is very much a test scenario. Tax sheltered annuities. Now be careful. RTFQ. That says to read the full question. Read the full question. So this isn't a tax deferred annuity. It's not like that variable annuity we talked about earlier where you're using after tax money. In a tax sheltered annuity, you're using pre-tax money. And that means, remember, you're going to have a zero cost base. Everything out is coming out as taxable. Now, the one test question is who can have a TSA? Who can have a tax sheltered annuity? Employees of nonprofits. So we're assuming this hospital here, let me get a different color here. We're assuming that she's working, this nurse, at this nonprofit hospital. So the doctor, the nurses, the admin people, not the patients. That would be the 501c. The TSA 403b is for an educational establishment. There's our professor there. Now be careful. That's just for him. It's not for the students. It's a trick test question, right? Not the students. But by the way, it's just not the teachers. It would be the nurses, or the school nurse, the school janitor, employees. They have access to this type of a qualified plan where they're using pre-tax money. We have the Teachers Insurance Annuity Association, CREF, TIAA, CREF, College Retirement Educational Fund. They're known in the business of the teachers. They're managing over $1 trillion, and a lot of it comes from these TSAs we're discussing. And then you invest it. Now, remember, the point here is they say, you've invested $40,000. Let me get a different color. And that's $40,000 that has never had back taxes paid. And now you take a distribution, 59.5 of 100, you owe taxes on the entire amount because you have a zero cost base. If this was a variable annuity, it'd be 60. So be careful. ERISA stands for every ridiculous idea since Adam. Not joking. It stands for the Employer Retirement Income Security Act. We had two major crises in the pension arena. One of them was we had a company called Studebaker who had all kinds of retirees who expected to get a paycheck in healthcare for the rest of their life. And then Studebaker filed bankruptcy. The other problem we had is the Teamsters kept lending their pension money to the mob. And so as a result of those abuses, Studebaker not making good on what they promised and Teamster doing things that they shouldn't do, we passed the Employee Retirement Income Security Act in 1974 called ERISA. And ERISA says you have to tell your employees how they become eligible. It doesn't do you any good to have a pension plan that you don't know anything about. So we say 21 years of age, 1,000 hours, you become eligible to participate in our pension plan. I haven't had anybody on debrief yet tell me they've seen anything on the Secure Act. How do we fund it? Remember, do we fund it with a percentage of the profits? We have to communicate with our people. We have a fiduciary responsibility, and we're supposed to be managing this for the beneficiaries. In not so proud moments in capitalism, I'm supposed to let you choose your beneficiary. If something happens to you, who would you like? So you're a beneficiary of the plan. If something happens to you, who would you like as your person to take over that? Your spouse or whoever it happens to be, usually spouse, but it doesn't have to be that. Now, remember, if we didn't have that rule, what used to happen is I'd say, where it says beneficiary, put El Jefe, Dean Tenney there. And now you get stuck in the mine. I have no incentive to come save you if I'm going to get your pension plan. It covers private or corporate pension plans. That's a test question. It does not cover public or municipal plans. Municipalities are allowed to have unfunded pension liabilities, and a lot of them have been downgraded, City of Chicago, for example, below investment grade because of their unfunded pension liabilities. If that were a corporation and you made those promises, ERISA would require you to fund the pension plan and invest the proceeds so you can, make good on the promises. We have to tell you how you become vested. I tell you, boy, Dearborn's plan was awesome. You're always immediately vested on the amount you put into that plan. So, the amount that's coming out of your paycheck, that 6%, if you're going to do the 6, you could do more than that, but that's always your money. Now on the match, we would tell our employees after the 5th year, all that money belongs to you. So year 1, 20, 40, 60, 80. I had an instructor work for me. His name was Patrick. And, I was trying to get him more money. I said, listen, I'd like to pay Patrick 85 grand to be a, senior instructor of Dearborn. And I couldn't get it approved. And he went looking for a job and he got a job as a host. They were making a couple $100 grand. Now we're not going to give him a couple $100 grand. And they said, well, we weren't going to give him that. I said, I know, but if we got him 85, he'd be happy. He wouldn't be looking. Anyways, I said, Patrick, before you tender your resignation, we should do some homework. I think you're pretty close to being fully vested, 5 years. That first year, 20%, 40, 60, 80. And when we did the homework, we found out he'd been with us 4 years and 11 months. I said, listen, you ought to structure your, your resignation so that you spend that last one doing something, teach a couple classes. So when you leave and you roll that money over into whatever retirement plan you'd like or leave it here, it all belongs to you. By the way, the test question, we have to tell you what that vesting is. You don't even know the vesting schedule, but ERISA requires us to tell the employees how they become vested, right? So they can make a good decision. When we sold Dearborn to Kaplan, the Kaplan men and women said, Dean, you drive us nuts. Every year you want more money for less work. I said, well, I don't know why that surprises you. I hope to be doing no work for a lot of money someday. I said, but good news, we're having this discussion after I'm fully vested. And they said, what's that mean? I said, that means all that money in that pension plan, if I leave, is going to come with me. There's no money in that pension plan that you've contributed on my behalf that I am not now control. It's now my money. So again, don't know any of vesting schedules. You know that ERISA requires you to tell employees how they get it, how they become vested. Well, that concludes the requested lecture for types of customer accounts. Hope you found it worthwhile. I think the other request that I'll be putting up is a suitability exam for practice exam, primarily suitability investment vehicles for 65, 66. The person who requested that, I think, made a good point. He said, Dean, you have all kinds of stuff for SIEs and Series 7s, but not so much content for 65, 66. So make sure you subscribe to the channel. I've been putting links out there, but I'm probably not going to be putting as much links. So you want to make sure you're getting the future lectures. Make sure you subscribe, like, comment. Hey, good catch. If I have a verbal, I've had a couple of video lectures where I made a brain fart and somebody called me on it, and I will say good catch and I'll fix it. So while you're watching these, if you find that, comment on the box if you like it. put the comment. I'm pretty quick at responding to questions on comments or potential typos or verbal errata that are, people find and put it in the box. I'm usually pretty good on that. So make sure that's available to you. If you are watching this, you also have available to you. And when you look at the about of the YouTube channel, I'm assuming that's where you're watching this. There's also a link to our subreddit. It's R Series 7. And that's a community where we provide support, emotional and intellectual, for people taking FINRA and NASDAQ tests. So feel free to join us. So until next time, like, share, subscribe, and comment. Oh, sorry, that was the wrong sound effect. That's the right one. Okay. So I'll see you next time.